Okay, so if you sell your property and buy another one, you'll get charged a penalty on your current mortgage. But if you increase your mortgage, you got to change your lifestyle with these rates, because otherwise you're going to dig yourself into a big hole of debt.
So ideally, you want to buy a property when you put 20% down. You're really leveraging yourself when you go below that 20%. You just...
They call it no penalty, but you're actually paying the penalty.
So how do I beat it, Dave? How do I beat it?
So you should start making changes now. Your spending habits.
What are some bad financial habits we should try to stay away from that majority of people get themselves into without knowing? Ladies and gentlemen, I just want to take a quick break from our show to say a massive thank you and a big shout out to one of our amazing sponsors, Dave DeStefano. Dave is a mortgage broker with over 13 years in the business, and Dave has a great rapport with a network of lenders, including big banks, credit unions, trust companies, financial institutions, and private funds. He will work on your behalf to help you find the best mortgage with the most agreeable terms and the lowest interest rate. After meeting Dave many times and having great discussions with him, he provides a level of confidence and comfort in knowing that he is going to take care of you. If you want to reach out to Dave, you can find his office on 6293 Thoroldstone Road in Niagara Falls. For more information or to make an appointment for any of your mortgage needs, call 905-933-1090. That's 905-933-1090. And thanks for listening. Back to the show.
What's going on, Meeting Gold listeners? It's Chris Battaglia, 416 Coffee. Use the coupon code Meeting Gold to get 10% off your first order at 416 Coffee. Enjoy the show.
Ladies and gentlemen, welcome back to the Meeting Gold Show. I want to introduce a good friend of mine and a long-time sponsor of the show, Dave DeStefano. Dave, how you doing, brother?
Good, how are you?
Good, man, good. Dave is a seasoned mortgage broker, and you probably would have heard it from his ad just before this. But, man, you've been in the industry for how many years now?
Going on 14 years now.
14 years.
Yeah.
Talk to me. We're going to dive right into it. Your first year, what was the one thing that you realized about mortgages that wasn't as easy as what you had thought?
Well, I mean, when I started in 2009, it was a completely different industry back then. And we were doing zero down mortgages like frequently. People were buying rental properties with no money down, multiple properties. And I always thought that was a little risky if you're, extending yourself that much, that quickly with no skin in the game, right? So that was a common thing. And that lasted about 3 years.
Even after 2009? Because when was the crash?
Actually, crash was in 2008. Is when I started. In 2008 was when everything happened in the States, right? So in 2009, when I started, it was starting to. We didn't get affected as much as the U.S. and Canada, but it was felt a bit. It was a different industry there. It's a lot different now. Qualifying was a lot easier back then. Again, the whole down payment thing was huge back then. I mean, a lot of people were able to buy properties with nothing down. It's pretty much paying legal fees.
Was it a false sense? I love the movie The Big Short because it goes into detail about this kind of stuff. Was it like a false sense of economy growth, do you think?
Well, it was also, that was a lot of fraud going on there too, right? So where people were buying properties, inflated values on the same street. I don't know if you know the whole story there, but they were refinancing. People were buying similar properties for way inflated prices, refinancing those properties, taking the equity out of them and just walking away from them.
Wait, hold on. So I'm going to try to dumb this down. So basically, I buy a house on James Street.
Yep.
With maybe say 5% down, or you're saying like almost nothing down.
Yes.
Nothing down.
Well, back then, yeah, you were able to, not anymore, but, and someone will get their partner or relative to buy the property down the street, end up selling it to one of their friends for a way inflated price. So now the whole street value has gone up in value. You understand what happened there? So your house is worth $600, you sell your place for $850. Now all of a sudden everything's worth $850 on the street. So they're refinancing the house that really isn't worth $850, taking that equity out and just walking away from the home.
So they're playing with the banks.
Yes.
And the banks were going along with it because they were winning too.
Yeah, that was back in, that's been rectified now, but that was happening a lot in 2008.
So did the banks know?
Well, that was in the
play
U.S.
along with it?
It was like in the U.S. it was a big problem for a long time there. So
this is so interesting.
yeah, no, it was. It was happening in like Atlanta, all those big cities were having neighborhoods that were selling for inflated prices. So that was a big problem.
So, okay, dumb down a mortgage for me, because I really want this whole episode to be about, like, you should be able to leave this episode understanding a mortgage, why it affects you, because it's something that should be taught in high school, in my opinion. Just the basics of a mortgage should be taught in high school, because that's what our economy is built on, is mortgages. Dumb it down for me.
Okay, well, if you're a first-time home buyer, you know, it's tough to get into the housing market right now if you're a first-time home buyer. But typically, you could put 5% down. You're paying an insurance premium on top of that, which is 4% with 5% down. So your equity is like 1% when you buy a property.
I see.
Okay, so your amortization has to be 25 years when you put 5% down. It can't be any greater than that.
So explain that one to me right there.
So you have an option of doing a 25-year AM or a 30-year AM. So what it means is your payments are based on, if you were to stay in that same term for 25 years, your mortgage would be paid off in 25 years.
Okay.
Okay.
Okay, I see.
But you don't, because the terms are usually 5 years. Your rate has to be negotiated after 5 years.
Interesting. Why is that? Is that just inflation?
Well, in Canada, you know, normally you could do a 10-year term too, but usually the norm is 5 years, so your rate is guaranteed for 5 years.
Why wouldn't I want to, as a consumer, wouldn't I want to make it a 10-year, because I don't want to renew?
Because the rate specials are usually on the 5-year, right? So if you get a rate of, let's say, 5% on a 5-year, your 10-year might be at 6%.
I see. So you're paying more at the 10-year.
Yes.
And then it's almost like that risk. Do you think the rates are going to go up or down by the time you renew?
Well, it depends. I mean, who knows? If we had a crystal ball, we would all be doing the same thing. But right now, the rates are the fixed rates are starting to come down a little bit now, like from what we've seen a couple months ago. Obviously, the prime lending rate went up a couple days ago on Wednesday. So that affects the variable rate mortgages and the lines of credits. People
In
with
what way? Break that down.
So your payments now, the prime lending rate now at the big banks is at 6.7%. So typically the big banks, a secured line of credit, you're looking at prime plus a half. So if you have a line of credit right now, a secured line of credit on your property, your interest rate right now is 7.2%, typically.
7.2%.
7.2%.
So you're going to pay, so explain the interest rate on how that affects your payments. Just give me like an example.
The latest increase that just happened, typically it's $15 and I think it's 20 cents per $100,000 that you owe. That's how much your payment went up on Wednesday.
Monthly.
Yes.
Interesting. Okay, so I buy a house for $1 million. I buy a house.
Yes.
So I get a mortgage I put down 20%. So I put down $200,000.
Yep.
I owe $800,000, and now I'm paying off that home. What you're saying is, with the prime lending rate going up to
the prime lending rate's at 6.7 right now.
6.7%.
Yeah.
That is how much I'll owe now every single month on the $800,000.
Well, it depends on what kind of mortgage you have. If you're on a fixed rate, it didn't affect you at all. Like the fixed rates right now, I can get probably around 4.7, 4.8%.
Why am I not just getting fixed rates all the time?
Because some people want the flexibility of wanting a line of credit. So if they get $20,000 or $30,000 they want to put down next week, they could do that. A lot of self-employed people like lines of credits because they can make a minimum payment one month, like an interest-only payment, and then suddenly put $30,000 down the next month, depending on how busy they are.
I see, because of fluctuations in their income.
Correct. So
a variable rate assists in that. So if I'm a growing business and, I'm 60 years old, I've been making $150,000 a year for the last 15 years. I don't expect that I'll make more or less the next 5.
Yep.
I go with a fixed?
Well, yeah, if your comfort levels with a fixed rate, yeah, I would definitely take the fixed rate right now. I am recommending 2 and 3 year terms right now because these rates should come down in the next 24 to 36 months. There's one thing I want to correct you when you said that, though. It's not a variable rate mortgage. It's a secured line of credit where you have the flexibility of putting interest only one month and like $30,000 or $40,000 down the next month. A variable rate mortgage is similar to a fixed rate mortgage, although your payment is going to fluctuate with the prime lending rate. So 6.7%, some banks will offer like a 50-point discount off of that. So right now, your mortgage interest rate would be 6.2%. If you're prime plus minus a half right now, right? But you still.
So how do banks? So banks will offer like a discount.
Yes, depending on they want you. Well, the variable rate they'll offer a discount off of prime. because it's restricted. You can't put, you can only put 20% usually extra on your mortgage during the year or every payment. That's normal, okay? The big banks, you can double up your payments, but there's restrictions on the amount of money you can put down. Whereas a secured line of credit, you want to slap down $100,000 next week or 200, you can. You have that option, right? So that's why the interest
without penalty.
That's right. That's why the interest rate is higher.
Because okay, this is starting to click for me. Because when you owe $800,000 on a home, let's say you win the lottery, you still can't just pay that $800,000 off tomorrow, right?
Well, you can, but you're going to incur a penalty.
You're going to incur a penalty,
right? So with a variable rate mortgage, your penalty is going to be 3 months of interest, which is pretty much the only option, the only benefit right now to having a variable rate mortgage, because your penalty will be minimal. Whereas a fixed rate, it's a little more complicated than just the 3 months.
Okay, explain that to me, because this is interesting.
Yeah, so I mean, so if you have a fixed rate mortgage, and let's say you're 3 years into a 5-year term, whatever's greater, the penalty, the banks calculated, they have their own little calculator they use there, but it's usually the greater of the interest rate differential, which means the remaining months on your term, whatever their current poster rate is compared to the rate you have now, that difference in interest rate with the number of months remaining on your term will be your penalty.
So it's like the median.
Yeah. So some of these penalties sometimes are $25,000 because of that.
Wow.
So if you're in a fixed rate, you got to be careful if you're thinking about selling or refinancing within that term. You got to be careful with those interest rate penalties, right? So.
Okay, and that's so. A lot of people don't just have $800,000 to pay off their $1 million home tomorrow unless they sell the home. So talk to me about that process, because you just brought that up, and I find that really interesting. Do the banks look at it differently when you're selling your home and you're trying to pay off the mortgage, or does the mortgage get transferred over to the seller? I mean, this is pretty basic stuff, but it's a lot of stuff that people don't necessarily know the answers
Well,
to.
I mean, some banks will offer, like, I'll give you an example, like a TD Bank type thing, okay? So if you sell your property and buy another one, you'll get charged a penalty on your current mortgage, but if you increase your mortgage by $20,000 on the next property, your penalty gets wiped out. If you go back to TD. If you go to a different bank, you're obviously going to incur the full penalty, right? But
I see, because TD wants you to stick with TD.
Yes, but your mortgage has to be $20,000 more than what your original one was for them to
because they're making the money, they don't have to charge you the penalty, they don't care.
Correct, yes. Other banks will offer you a blended rate. So if your rate is 4%, their current rate's 5.5%. They might offer you a rate of 4.7. They call it no penalty, but you're actually paying the penalty because it's absorbed with the new interest rate, right? But it's not coming out of your pocket. It's not coming out of pocket, right? But your rate it's called a blended rate. So, but that's when you stay at the same bank. If you move banks, then you're gonna pay the full penalty.
So, Dave, I'm 20 years old. I have $100,000 saved. What am I doing it with? I want to get a property. How much am I putting down? What am I looking at? What would you advise?
Well, I mean, it's whatever you qualify for, too. What I advise is, I mean, obviously you should get pre-qualified to see what you're good for. But let's say you qualify for a $500,000 purchase, okay, and you want to put $25,000 down. Well, if you have $100,000, that's ideal because you're not paying the premium if you want to put the full amount down, 20% down.
So ideally, you want to buy a property when you put 20% down. You're really leveraging yourself when you go below that 20%. You're betting on yourself that you're going to win.
Well, I mean, it's considered a high ratio mortgage, right? So you're paying a premium. I mean, you're paying a 4% premium with 5% down. You're paying 3.1% with 10% down, and there's an interval, right? It goes down to 2.8 if you put 15% down, right?
I see.
So that's added to the mortgage. I mean, it's not coming out of pocket, but still, it's part of your mortgage, right? So,
so what things when you're looking at okay, let's say I had no help from my parents and whatnot. I'm 19 years old, and I'm gonna have to co-sign on a property with my parents if I want to buy a home before I'm 25, probably. Like, there's almost no option. Yep. Or I just have to work my ass off for the next 7 years, take weekends, work them, and then save my money.
Yep.
What am I doing? I don't have any parental support. I want to put down 5% on a home. Is there any assistance from the government for me?
Well, the first-time home buyer incentive really is it's a couple things. One, you're not going to pay. Well, you're not going to pay, but you're going to get a $4,000 reduction off your land transfer tax. So if you buy a property, land transfer tax is $5,000. You're getting a $4,000 discount as a first-time home buyer. So it's only going to cost you $1,000 as a difference. Okay. You can withdraw money out of your RSP tax-free up to $35,000. They give you 15 years to pay it back. Okay, so it doesn't have to be paid out back all at once, and that's going to Obviously, that's a huge tax break for you. You'll get a.
And you want to be putting money in your RSP.
Yes. As far as like down payment assistance, there's programs out there. Like there's Niagara Regional Housing that has that. The renter program. So if you're renting right now, they're offering it's selective people. Not everybody gets it. I think qualifying now is your household income has to be under 85,000 or 86, something like that.
Okay.
You have to be renting. Liquid assets under $30,000, and you can apply for a down payment that's forgivable after 20 years. So if you live in that property for 20 years, 21 years, you don't have to pay back that 5% down payment they're giving you.
Wow. Okay.
Yeah. I think it's capped at 20. I have to look it up because it changes, but I think it's around 24,000. So it's not quite. I mean, you're looking at around a property around 480,000, where you can apply for that 5%.
So, Dave, when you're talking about mortgages, let's take it back a little bit. You just spilled some gold on exactly how a mortgage would work and what I should be aware of. There's the argument, you'll hear Bob Ramsey say, don't go in debt, don't go in debt, don't go in debt. I don't know what he says about mortgages, but mortgages, are they like going in debt? And then my next question to follow up with that is there good debt?
Well, I mean, I tell people, I mean, it's funny because you'll have clients come in, they have a mortgage of $300,000 on a property that's worth $700,000, and they're carrying a lot of credit card debt and lines of credits. You know, they have $20,000 MBNA cards and, $10,000 Visa cards. And I look at it, I'm like, they're paying 21% interest on these cards sometimes. They're not paying these things off. So is there good debt? I mean, if you have debt like that carrying outside of your mortgage, I recommend you put it on your mortgage because the interest rate is obviously a lot better than what you're paying on these credit cards. So yeah, your mortgage will, a lot of people do choose to refinance. So if you do have like $50,000 or $60,000 of credit card line of credit debt, I mean, it's advisable to roll that into your mortgage because you're paying it at, a 5% rate, right, as opposed to 21%. Are you taking from the equity of your house? Yes, but it's not advisable to carry 21% interest rate or whatever you're paying on your credit cards.
Yeah, which is ridiculous.
And I see it way too often. It's people. It's weird because some people's mentality is, well, I'm paying down my mortgage, but I mean, yeah, but you have a $30,000 credit card balance that's carried over every month. You should get rid of that. And you're not getting anywhere by making these payments every month.
Okay, so this literally leads right into my next question. It'll complement it really well. The challenges you see with consumer spending and just overall financial habits, talk to me about what you're seeing individuals, it doesn't necessarily have to be young, but just individuals in general. What are some bad financial habits we should try to stay away from that majority of people get themselves into without knowing?
Well, I mean, everybody got comfortable with those rates being so low the last 3 years. I mean, rates were at 1.79, 1.99, 2%, and people got used to that. Okay, so now the rates are at 5%, and I'll tell you, I'll give you an example. We're now in 2023. I mean, people in 2017 and 18 had rates of 2%. Now renewals are coming up. Their mortgage renewals are coming up, and their payments in some cases are going up like $600-700 at renewal because they had a rate of 2%. Now they're being offered a renewal at 5%. So they're carrying a $500,000 mortgage. Your payment's going up $700-800 a month. So their spending habits sometimes, going to the restaurant twice a week. Whatever you're doing, shows, dinner, whatever you're doing. Some people they get used to that. And to maintain that level, of whatever you're used to, sometimes you got to use your credit cards, your lines of credits to maintain that. And that's not a good thing. You got to change your lifestyle with these rates because otherwise you're going to dig yourself into a big hole of debt, and it's going to continue.
So how do I beat it, Dave? Dave, how do I beat it? How do I beat the rat race of just living with my mortgage?
Well, I mean, again, you got to set a budget every month. If you're a family, especially, you have to set aside, this X amount of dollars for, leisure, travel, that sort of thing. Make sure you have your numbers based on the interest rates now, not at what you're paying. Like your rate could be at 2% still, but I would start planning right now that you're going to be paying 5% soon. So you should start making changes now.
So building that emergency fund, it's actually funny. I saw a clip of Joe Rogan say on his podcast, he mentioned it doesn't matter who you are, you cannot tell me that you cannot save $100 a month. And it was an interesting point he made because the overall message and what's behind it is just save something. Just save money. Don't live on what's the now because you don't know what the future is, right? What do you see a lot of people not even thinking about, right? Like almost just like, how could you not have thought about that? Do you see that, or is that not something that's happening now?
The younger generation, first-time home buyers, they don't know any better, right? So, I mean, 2% interest rates, first-time home buyer back in 2018, 17, they don't see this. So they got used to it. A seasoned, homeowner from, like 10, 15 years, maybe they thought ahead. But typically the 50 or 20-year homeowner has a bit of equity in their house too, right? So they're not as leveraged. So I guess it's a sign of your generation, I guess. I guess it's a mentality thing, right?
I think it is. It's consumer spending. At the end of the day, you're spending your money in things that maybe you value, but are they going to benefit you in the long run, right? And there's a fine balance. Like, can I go to the arcade on a Friday night? Sure. But how many times do I do that, right?
I mean, daily leisure spending, it adds up. Like, I mean, Starbucks and whatnot, lunches, it does add up at the end of the day. I mean, if you sit down and do the math, it's you're talking thousands of dollars every year that you could be saving.
Yeah.
Right? So it's
They said the average person, I think, spends over $2,000 a year on coffee.
It's probably, that's probably accurate.
It's like,
I'm one of the culprits. I'm one of the culprits. So,
yeah,
I mean, sometimes
I can't blame you. I mean, it's good fuel. Dave, one of the things that I cannot seem to wrap my head fully around, and I think a lot of people struggle with this, I'm asking from somebody who came out of high school, doesn't have, college or university education, but feel as if I'm a little frustrated that these things weren't taught to me, because I feel like this is something that everybody deals with. This shouldn't be something that I have to pay $40,000 for a 4-year program to learn about mortgages. I want to know. Doesn't mean I won't use a mortgage broker, but I want to know how this stuff works so I can walk in better educated. What can I do to be better educated with my mortgage decisions?
Well, I mean, it's again, you're not going to learn this in high school. They're not going to teach you this, but I mean, it's life. I mean, you could talk to your parents. I mean, if they're still in tune with what's going on right now, that's one thing. Maybe a family member, but again, a broker like myself, we have. We could sit down. Like I do this every week. I have first-time home buyers come in my office, and I explain the process to them. Oh, I didn't know that. And that's good because they write things down, and it's stuff that we could teach them.
Right.
Closing costs are another thing you have to be aware about. Lawyer fees and land transfer tax. That's stuff that's sometimes overlooked by people. Oh, I have $20,000. I have a down payment. Well, there's extra costs on top of that you need to know about.
Right. So how much percentage-wise, if I'm going to be buying a home, how much should I be worried about? Like add it on. When they say, so when we were doing the renos to this building, we were obviously over budget. I tried my best to budget it, but we were definitely over budget. And people always said to me, plan for an extra 20% all the time. Mm-hmm. Is that like a mentality you should have when you're purchasing or selling a home?
Well, if you're a first-time home buyer, the rule of thumb we have is your down payment, and the lender too wants to see that you have 1.5% of the purchase price for closing costs. So that's land transfer extra, the legal fees, title insurance, all that sort of thing that you need to come up with, right? So that's
$500,000 I purchased the home for. I should have an extra 1.5% of the $500,000 saved to pay for.
Yeah, like $25,000 would be your down payment on that, and you need another 1.5% on top of that as a cushion to for closing costs.
So one of the things that I really want some better education on, and I just can't seem to understand, is the rates. Dave, I hear rates all the time. I don't understand what makes rates fluctuate. What changes a rate from 3% to 3.25% down to 3.8%? Why is that changing? I don't understand.
Okay, well, the prime lending rate, which is it's governed by the Bank of Canada, they just increased this rate by a quarter point on Wednesday this week. It's been increasing steadily over the last, it's been on the news, right? But that's been happening to curb, obviously, the inflation rate still being over 6%, okay? And they want that inflation rate down to 2%. So that's the Bank of Canada's way of trying to control that inflation rate, okay? They're trying to get consumer spending so there's not as much demand for products to get this inflation rate under control. Now, depends on who you talk to. I mean, Bank of Canada is doing their thing, but there's a lot of people that don't like the fact that they're raising these rates.
So quickly?
Well, not only so quickly, it's not the only problem. I mean, there's a supply and demand issue too, with this inflation rate too. I mean, if you know, I mean, the pandemic didn't help, obviously, right? But if you think about it, I mean, less people working. You know, someone wants to buy a car, and there's 10 people doing the same thing. They want to buy that one car. Obviously, you know, they could raise their prices as much as they want when you have 10 people wanting to buy one car. Well, if there's 10 cars, I mean, you got to keep your price pretty competitive, right?
Yeah.
It's a rule of thumb here. So I think it's a two-sided coin. I go, yeah, I mean, they're doing their part. It is coming down a bit, the inflation rate, but I think the other thing that I just mentioned, the supply and demand thing, is a huge factor as well. And that's not under the Bank of Canada's control, right. But they're doing their part, and that's all they can do right now. So they're increasing their interest rate, right?
So one of the things, I always love playing devil's advocate with this type of stuff. The inflation issue was, it seems like, I mean, even before COVID, it was an issue. It was slowly starting to come up, and it was almost. They say inflation's like it's a blind devil, right? Like it'll just come and attack you without you even knowing, and it's like you can't even see it, right? So you can try to factor for it, but that inflation thing, that was an issue years ago, but it seems like in a year we're trying to solve an issue that took 6 years to create. Shouldn't it be more like that? Like if the issue's arising, instead of trying to resolve the issue by going like this and halting the whole market, shouldn't it be more like this? Shouldn't they try to ease it a little bit more? Or do you feel that they did a good job easing the problems?
I think the inflation rate was so out of control. Like 6 months ago, it was over 8%. They had to do something. They pushed the panic button is what they did, right? So that's what's happening right now. This last increase of a quarter point, they're saying, is going to be it for a while. So they're going to let this play out, see what happens. You know, hopefully this inflation rate gets under, you know, maybe at 5.5% to 5%. I don't see it getting to 2% anytime soon.
Yeah, no.
Even though they want that, you know, I don't know how.
Well, how much money did we give out during COVID, right? Like,
yeah,
that has to be recouped.
I mean, that didn't help. COVID obviously was a big factor here too. I mean, the war in Ukraine, everything else going on too, right? But the supply and demand factor to me is probably a bigger issue than anything. Okay, and that's. I mean, it's
where we sit with that right now, the supply and demand. Like, where are we right now on this day of filming, January 26 or 7?
Well, I think we're coming out of this pandemic. I think it's slowly starting to, you know, things are getting back to normal. So hopefully these factories are back at 100%. People are back to work 100%. Layoffs have all been called back. I mean that's gonna be huge. That should help out. But I mean, who knows? I don't know. No one knows. You know.
Yeah, it's tough. You almost have to predict it without you don't even know.
Yeah.
So now let's bring it back to the mortgage side. When you're looking at a supply and demand issue, are there like this factor? But then I'm assuming there are other factors that you look at to predict where the mortgage rates are going to stand and how you can best advise your clients. What are some of those factors that you look at?
Well, again, the variable side and the fixed rate are I mean, to me, they're in unison, but they're not, because the variable rate is you know, contingent on what the Bank of Canada decides to do. So if they decide to raise the rates again, obviously your payments are going to change on the variable rate side. If you're a first-time home buyer right now, fixed rate is the way to go, because you need stability. You need to know what your payments are every month. Okay, you don't have a lot of equity in your house, so you need to be you know, on a budget and knowing what you're paying every month.
Just plan for it.
Plan for it. I mean, when you're buying a house, obviously there's a lot of renovations you need to do, and you know, people like to leverage their lines of credits and buy things that are probably not necessary right now, but you can wait. You know, wait a couple of years, get some equity built in your home, try to put it, you know, on a secured line. I don't advise clients to take out unsecured lines unless they're necessary. I mean, you know, don't finish your basement now. Wait till you have a little more equity in your house, because you're going to leverage yourself too much, and it's, you know, you have a mortgage payment that may change, you know, if these fixed rates do change again, and paying, you know, an extra $300-400 a month towards a line of credit or credit card, it's not
something you want to tack on.
You don't want to get used to doing that, right?
It seems, and it's actually interesting. So we just purchased a new computer for the studio, and you know, it's an investment because it helps with a lot more productivity. It's a faster computer. We can get more projects done. But what Apple does is 0% APR. You can just purchase it. We put like $700 down, and now we pay like $600 a month for the next year. it's easy to do that. But then eventually you get into the habit of doing it, is what you're saying is that is like that blind knife that's behind you that you can't see. And eventually it slowly starts to stick in you. And you'll feel it, but it might be too deep before you really do.
Correct. I mean, and that's the, again, I'm seeing this a lot with first-time home buyers where they get used to certain things, okay, and it's a shock to their whole lifestyle, right? I mean, paying an extra $700 a month for a family, making
That's ridiculous.
$150,000 a year. I mean, that changes a lot of lifestyles, and it's going to continue because, again, back in, what are we, 2023, I still got to think back what year it is now. In 2018, rates were all in the twos, like I explained to you, 2%. Now the renewals are coming up, and they're calling me saying, hey, why are they offering me 5.25%? Well, that's what the rates are now. They're not 2% anymore. Well, can I just keep my same rate? No, you can't, because your term was 5 years, and your rate has to be negotiated again. And again, that's where the big shock comes in. Now you're paying, like I said, $600-700 extra a month that you weren't. And that's huge.
And it'll affect you. So, Dave, what do I do now as we kind of close off the interview? What do I do as a first-time home buyer? What are you advising me? What are you saying? Hey, what should I do? Calm me down.
If you're able to get into the market now, it's a great time to get in the market because the prices have come down. Okay, houses right now. I'll give you an example. This time last year, houses that were $700,000 are probably selling for $575 now, $550. So, yes, you're paying a higher interest rate right now, but you're paying less for the house. So you would have got a rate of 2% last year. Okay,
paying $800,000 for a home.
So your payment's going to be the same now because you're paying less for the house. The rate's higher, but you're paying a lot less. So your payments are pretty much the same. It would have been just that you're paying less for the property. If you can afford to get into the market right now, it's a good time to get into the market. Your budget should be based on the current rates because if the rates do go down, in 2-3 years, we're all hoping they will. We're probably within 2 years. You're going to be laughing in a couple of years because then you'll be used to these payments, and you'll have those extra funds available to you, in a couple of years.
I see. So just stick it out. Plan ahead. Be positive for the future.
Yeah.
Don't freak out.
And you should have a budget. I mean, if you're a family, especially, you should have a budget and set aside, and stay within that budget every month.
Set aside money every single month.
Correct.
Force yourself.
Yep.
Yep. It couldn't be more accurate. Dave, I want to go to you for mortgage help, advice. Where can I find you?
I'm in Niagara Falls. Obviously, I'm online, but I'm in Niagara Falls. I'm on Thurlestone Road, 6293 Thurlestone Road. I've been at that location now for going on 7 years.
How do you like it there? It's a nice place, eh?
Yeah, it's great. I'm right by the Five Corners. I have a big sign there by the Five Corners. You can see my sign. If you're at the stoplight, you can't miss my sign. It's huge.
You're right by the Hercs, right?
Across the street.
Across the street.
Yeah, there's a plaza there. I'm 2 doors down from the plaza.
Oh, beautiful.
So obviously my number is online. My email's online.
Just look them up. You'll be able to find them. Val does a great job at that stuff.
Yeah, she does. Yeah, she does.
I love it. Dave, man, thank you so much for jumping on. Guys, if you have any mortgage questions, make sure to reach out to Dave. Like I said, he's been a big supporter of our show, and if I can show him any support, it's just encouraging you to reach out to him. If you like this advice, make sure to leave a comment down below. Ask any other questions. We'll get them answered for you. And we look forward to seeing you in the next episode. Cheers, guys. See ya.